For a look at the markets, let's bring in Paul Zemsky, CIO at Voya Investment Management. You're feeling good? Feeling good. You did take some money and go into Europe and emerging markets, but you're still very bullish here.
Overall bullish. Overall, been overweight stocks for the entire year, mostly in the U.S. Now started to move some into the European area and also a little bit into emerging markets. It's basically to get more exposure to cyclicals, right? So the economy is bottoming. We see green shoots in Europe, green shoots in the EM. You know, we believe the purchasing managers around the world are bottoming. So you want to be more in cyclical stocks, and you look at the sector mix of Europe, it's better cyclical plays, and we want to be part of that.
Stocks here, not overvalued, not expensive. They'll be strong in the year end, but in the second quarter of next year, you start worrying about the election.
Yeah, I think
the uncertainty or Elizabeth Warren or what?
Both. Yeah. So uncertainty, we know from the tariffs and other things, the market just hates uncertainty. Businesses want to be able to plan, want to be able to know what the rules they're playing by are. And as the rules change, people pull back, businesses and consumers. So, you know, the economy is very strong. I think that is what drives people to reelect the president.
She's down 50%. Have you looked at her number on predicted?
Yeah, she peaked early.
She's down.
She peaked early.
And Buttigieg and Biden are tied now, basically.
With Medicare for all, right?
What do you like about Europe? I mean, Europe's at a massive discount to the U.S. in terms of valuation. Are you expecting to see earnings growth, multiples re-rate, both?
Both. So Europe has a lot more banks, right? And look at Germany's yield curve today. I mean, the 10-year Germany note is up by 5, 6, 7 basis points today. So Europe was pricing negative rates forever. And while we may have zero-ish negative rates, they're not going to be negative 70 basis points like we had just a few months ago. So like the idea of the reversion of the yield curve getting steeper, rates getting higher. And also Europe is a much more industrial base. And as we see the world's industrial activity bottoming, European companies should do well.
As we approach the end of the decade here, the 10 years of muddling through in Europe could be over.
Right now it's more of a tactical. We'll see if it warrants a strategic position. But right now it's more of a 3-month, 6-month play.
So we have gotten this far without Europe. And so you figure, and I'm talking about just the underlying economy here in this country, if there's green shoots in Europe, then we do well here, and the unemployment rate stays lower, gets even lower. That brings the Fed back in.
That's a second half problem of next year. So we're on course with over 200,000 jobs expected this month. The 3-month average about 160. That'll keep putting downward pressure on the employment rate. So we could be in a situation come midsummer where we're looking at a 3.3, 3.2 unemployment rate, and then you got to start thinking about what the Fed's going to do.
You don't see job growth decelerating at this point?
Well, it did, right? So we were
because
above
it's
200.
hard to get people, right? Is it?
Well, it's hard to get.
Above, yeah.
You know, you talk to businesses, they say I can't find anyone. Well, you can't find anyone at the price they want to pay. But if you raise your wages, you'll get people. There's still people on the sidelines who could come in.